Free money for everyone! The International Monetary Fund, the IMF, has decided to hand out 550 billion euros of new money, and everyone is getting some. What's up everyone, my name is Joris, welcome back to my finance channel. The International Monetary Fund has announced that they will create $650 billion or 550 billion euros in currency reserves and will hand out those to all 190 member states. These new reserves are issued to help the developing countries, those who are hit the hardest by the pandemic. It should reinforce the resilience and the stability of the world economy, and the worldwide liquidity will be supported. This is a historic decision, the largest SDR, special drawings right, allocation in the history of the IMF, and a shot in the arm for the global economy at a time of unprecedented crisis. The SDR allocation will benefit all members, address the long-term global need for reserves, build confidence and foster the resilience and the stability of the global economy. It will particularly help our most vulnerable countries struggling to cope with the impact of the COVID-19 crisis. Words by the IMF Managing Director Kristalina Georgieva. Now, what does this mean in particular? The IMF can create new money out of thin air. They create these SDRs or special drawing rights and they will hand them out on August the 23rd of this year to all member states. These SDRs are not real currency, but more like a promise to exchange these tokens for hard currency in the future when they are needed. It's not an obligation, but it is an option to do so. When a country exchanges their SDRs, they would get an amount of dollars or euros or yen or UK pounds at a fixed and preset exchange rate. The value of the SDRs is based on a basket of the world's 5 leading currencies: the US dollar, the yuan, the yen and the UK pound. The SDRs are seen as a stable asset in a country's international reserve. It is the 4th time the IMF issues these SDRs. But this time the amount of money handed out is a lot greater than previously. During previous crashes in the market in 1970, during the time where there was too little oil reserves, in 1979 during the second oil crisis, and in 2009 during the financial crisis, a total of 204 billion SDRs were given out. But that total amount spread over 40 years is totally dwarfed by the proposed 456 billion SDRs to be issued later this month. By the issue of these SDRs, the IMF tries to help poor countries with a strong currency option plan. A lot of the poorer countries have had a major impact during the pandemic and their currency reserves shrunk very fast. They will now be able to use these SDRs to get strong currencies to buy vaccinations, to support their own economy and currency, or fight global warming. The SDRs are free, but they are also worthless as is. Their value lies in the exchange for hard currencies. If a poor country exchanges their SDRs for dollars, the national bank of said country will have to pay interest on the money received, and they pay these interests to the IMF. If another country then lends out their money to pay for the SDRs, they receive interest on the money they are lending out. Let's say country A exchanges their SDRs and they have received $1 billion. They now pay interest on this loan of $1 billion. Country B then lends out the needed $1 billion. They receive the paid interest by country A via the IMF. The interests on the SDRs are calculated by taking the mean of the short-term interest rates in the USA, the Eurozone, Japan, the UK and China. At this point in time, the interest rate of the SDRs is 0.05%. That is an extremely cheap option to lend money, especially for the poor countries, since they have to pay extreme high interest fees if they were to finance publicly on the bond market. A loan at 0.05% is obviously preferable to a loan of 7 to 10%. This way of financing is very welcome for these poor countries. They essentially get free money in a strong currency. And even if they have problems with their own inflation levels, the SDRs will provide some sort of stability. On the other side of the world, the richer countries won't use the SDRs very soon. They can lend money even cheaper via conventional ways of finance. I don't see why Belgium would use the SDRs if they can lend money from the European Central Bank at a very much lower rate. They can get money at an interest rate, a negative interest rate of 0.5%. The IMF hands out the SDRs to all of its 190 members, but not everyone gets as much as the next. Depending on the gross domestic product and the export of each individual country, the rates are calculated. For example, the USA receives 17.43% of the SDRs, Japan gets 6.47% and China gets 6.40%. Belgium, as a small European country, will get 1.35% of the SDRs. But African countries also get a share, albeit extremely small. But again, this is calculated according to their gross domestic product and their export rates. This way of dividing the funds gives more than 50% of the SDRs to rich countries, even though they don't really need it. The emerging countries will get 42% and the really poor countries will only get 3.2%. In total, $650 billion will be distributed worldwide. But it won't be enough. The IMF states that between 1.1 and 1.9 trillion dollars are needed, so double or even triple of what they issue right now. A bigger support plan will probably be withheld by the USA, since the plan will hand out a lot of money to Russia and China, and that won't be in the favor of the USA. By having 16% of the votes, the USA can and will withhold such decision. They just don't want to give their competitors too much of a financial advantage. So we are stuck with the $650 billion, divided as it stands, most of it for the rich countries and little for the poor countries. But in dire straits, there are options to give the poorest of countries more support than they are getting right now. Richer countries can lend out or even donate a part of their SDRs voluntarily. Back in the days during the previous global crisis, a total of $15 billion in SDRs were donated to other countries, who in turn got their interest-free loans. The IMF and several richer countries are now working on a plan to donate up to $100 billion to poorer countries. Giving a lot of money to poorer countries does pose a risk, albeit rather limited. The whole donation of $650 billion worldwide is acceptable, because it's just around 1% of the total global gross domestic product. It won't cause any inflation on a worldwide scale. Maybe a little on the short term and on an individual country scale, but since all of the money is not transferred as is in one time, the money can only be requested when needed, the inflation can be kept in line. But what are the consequences for the global economy and the stock markets? In 2009, this money injection proved to be very healthy for the bond market of the emerging markets, which is quite obvious. Poor countries with poor management lack trust in their financial status. Now they receive a lot of money and they can use it to improve the quality of their country, the currency and their economy. Worldwide investors will trust their government more and the interest rates of newly issued bonds will be lower. There will be less money needed and outstanding bonds become less risky. Current bond prices with higher returns will be more popular and thus their prices will rise. For richer countries with stable currencies, the SDRs are less interesting. As said before, countries in Europe, like Belgium, can lend money at the European Central Bank at a negative interest rate. So there is no real use of using the SDRs right now. But a good thing, the SDRs in theory are valid indefinitely and they can be kept on the books until needed. If Belgium in the future, somewhere in the future, faces a major financial crisis, the SDRs can be used to prevent worse. For the richer countries, they are basically a financial get-out-of-jail-for-free card. The money creation of the IMF is a great way to push the global economy. But as with all financial support programs, it always favors the richest countries. The financial program of $650 billion kind of misses its target. Most money stays in the rich countries, and the countries that are affected the worst, those that really need it, won't receive a lot of support. Most developed countries have already overcome the hit of the global pandemic, while the developing and the poorest countries will have to wait for years to reach their previous levels. the gap between those two worlds grows again immensely. The IMF would better restructure the idea of the distribution key and favor the poorer countries. But that seems to be a bit late now. Anyway, for us as investors, this again is good news. The stock market won't suffer because of the new money, but it shouldn't react too much either. Since the SDRs can only be used in dire straits, the money will just sit on the sideline and won't go into the market just yet. The markets or economy won't be supported by it. Well, at least not in the developed world. In the developing and poor countries, the money will be used in the next few years, supporting their local economies and making sure that the supply chains are again being set up. This results in the lowering of prices of commodities, which will drive up profits for the manufacturing businesses and thus supporting the economy and the stock market. The IMF states that they don't expect inflation due to this financial support, but it will have an effect on the economy and indirectly on inflation levels. Maybe only on the short term, but there will be consequences. To shield yourself against this inflation, this short-term inflation, you have to make sure that your cash money is protected. You can do this by investing it in assets, thus it will keep its value and start generating more profit over time. As said before in my other videos, even though the markets are high at the moment, especially if you look at the price to earnings ratio, most companies succeed in surpassing their expectations and prove that they are worth of those high PE ratios. At this moment, the potential upside in the market is far greater than the potential downside. But if you are still hesitant to invest, just spread your investments over time and use the dollar cost averaging method or the DCA method to spread your investments and limit your risk. Don't forget to like the video for the YouTube algorithm and subscribe to the channel. Share the knowledge, talk with your friends about personal finance and break the money taboo. I thank you very much for watching and until next time.